Ubiquiti, the enterprise networking company building Wi-Fi, switches, cameras, and access control at a fraction of the cost of traditional vendors, sold directly to IT professionals with no reseller margin.
Q3 FY2026 revenue $788 million, enterprise up 22.6%, FY 2026 guidance $3.414 billion. New 80-cent quarterly dividend initiated.
Ubiquiti was founded in 2005 by Robert Pera, a former Apple engineer who saw the gap between enterprise networking costs and complexity. His bet: sell direct to IT professionals and cut the reseller margin.
Ubiquiti went public in 2011. By 2016, Unify dominated prosumer and SMB enterprise features at consumer prices, sold online, without a traditional sales force.
By Q3 FY 2026, Ubiquiti serves over 20 million devices globally, generating nearly $800 million in quarterly revenue at operating margins exceeding most enterprise networking peers.
Enterprise technology, Unify Wi-Fi, switches, cameras, and access control generated $717 million in Q3, up 22.6% year-over-year.
Service provider technology, outdoor radios for WISPs, contributed $70 million in Q3, down 10%, as competitive wireless alternatives compressed demand in that segment.
Q3 revenue $788 million versus $839 million estimate, a modest miss. Non-GAAP EPS $3.88 versus $4.42 estimate. FY 2026 guidance $3.414 billion.
Ubiquiti's new 80-cent quarterly dividend, annualized $3.20 per share. FY 2026 non-GAAP EPS guidance is $16.58, a capital return signal from a near-zero debt business.
Cisco Meraki competes at 2 to 5 times higher price points. HPE Aruba competes in enterprise Wi-Fi. Neither matches Ubiquiti's direct-to-IT professional distribution and margin structure.
TP-Link and Netgear compete below Ubiquiti in SMB and consumer segments. Unify has defended the prosumer tier by expanding into cameras, access control, and VoIP, keeping administrators within the ecosystem.
Ubiquiti's moat is the IT professional community, installers and in-house IT teams who have standardized on Unify across thousands of deployments. Switching means retraining the entire install base.
Ubiquiti sells globally. The United States is the largest market, followed by Europe and Latin America. Hardware ships from regional fulfillment centers directly to IT professionals with no retail presence.
The enterprise technology segment drives growth. Unify has expanded from Wi-Fi into switching, routing, cameras, access control, and VoIP. Each category adds attach rate across 20 million installed devices.
Robert Pera founded Ubiquiti in 2005 and has served as chief executive officer since inception, holding a majority voting stake and running the company with no sales force and no traditional distribution.
Pera brought Apple hardware discipline to enterprise networking. Ubiquiti reached multi-billion-dollar revenue with margins in the high 20s, without sell-side coverage or earnings calls with Q&A.
Ubiquiti, the enterprise networking company, $788 million in Q3 revenue, enterprise up 22.6%, FY 2026 guidance $3.414 billion, new 80-cent quarterly dividend initiated.
Q3 FY 2026 non-GAAP EPS $3.88 versus $4.42 estimate. A modest miss, but enterprise growth 22% confirms the platform expansion is intact. A $51 billion market cap for a company with no sales force and no traditional distribution. That is the Ubiquiti anomaly.
Ubiquiti just posted fiscal Q3 2026 results, and Wall Street did not like what it saw. Revenue came in at $788.2 million, up 18.7% year-over-year, but the street was expecting $838.7 million. That is a $50 million miss. The stock dropped roughly 7% in pre-market. Today we break down what happened and whether this dip matters.
Ubiquiti makes enterprise networking hardware, Wi-Fi access points, managed switches, security cameras, and routers. Their customers are businesses of all sizes, reached almost entirely through value-added resellers. There is no traditional direct sales team. That is not an oversight. It is the strategy. By eliminating a costly sales force, Ubiquiti keeps its cost structure razor-thin and passes savings back through product pricing that undercuts rivals on a massive scale.
And the result? is a business generating close to $3 billion in annual revenue with a market cap around $62 billion. That valuation reflects what the market thinks this lean model is worth over the long run, even when a single quarter falls short of expectations.
Let's walk through fiscal Q3 2026 by the numbers. Revenue landed at $788.2 million, up 18.7% from $664.2 million in the year-ago quarter. That is genuine double-digit growth. But analysts had penciled in $838.7 million, so the miss was about 6%. Meaningful for a company this size.
On earnings, non-GAAP EPS came in at $3.88 against an estimate of $4.42. That is a 54-cent shortfall. GAAP EPS was $3.86. Gross margins improved year over year, though Ubiquiti did not disclose the exact basis points. Classic Ubiquiti minimal disclosure. The company also declared a cash dividend of 80 cents per share.
Looking forward, Ubiquiti issued Q4 FY2026 guidance of roughly $894.4 million in revenue and approximately $4.61 in non-GAAP EPS. For the full fiscal year, they guided revenue to approximately $3.414 billion and non-GAAP EPS to approximately $16.58. Those are meaningful step-ups from Q3 actuals.
So the big question is, why did Ubiquiti miss? The company holds no earnings calls. There is no investor Q&A, no management commentary beyond the press release. Analysts are essentially flying blind, building models without the granular channel data and segment color most companies provide. That information vacuum is one structural reason the street overshoots on estimates.
There is also a hardware refresh dynamic at play. Ubiquiti's products have multi-year replacement cycles. Timing of when enterprise customers refresh their networking infrastructure is lumpy by nature. A quarter where fewer large deployments close can move revenue by tens of millions, and if analysts model a smoother curve than the actual choppy reality, you get misses like this one.
Robert J. Pera is the founder, chairman, and CEO, and he controls roughly 90% of the voting power. He runs Ubiquiti with minimal outside input, holds no earnings calls, and keeps the operating model deliberately secretive. Pera built this business on the principle that great products sell themselves. That philosophy shapes everything, including why Wall Street stays perpetually uncertain about quarterly outcomes.
Analyst sentiment on Ubiquiti is genuinely complicated. The $62 billion market cap implies a premium multiple on a business that just missed revenue by 6% and EPS by more than 12%. Some analysts argue the valuation already prices in a best-case scenario for the lean model, leaving little room for error when quarters disappoint.
But the bull camp on the street points to the full-year guidance as the tell. If Ubiquiti management is comfortable guiding to $3.4 billion in fiscal 2026 revenue, the Q3 softness looks more like timing than trend. The Q4 guidance implies a big sequential ramp, $894 million versus $788 million, and management has historically been conservative with their numbers.
The fundamental model also has characteristics the street broadly respects. Hardware refresh cycles are predictable in aggregate, even if lumpy in any given quarter. Enterprise networking is sticky. Once a company deploys Ubiquiti infrastructure, switching costs are real. That hardware renewal stream behaves more like a subscription than a one-time sale, which supports recurring revenue assumptions even without formal recurring revenue accounting.
The miss on estimates also has a partial explanation that is structural. Without earnings calls, guidance ranges, or segment disclosures, analysts modeling Ubiquiti are making educated guesses with limited data. The consensus estimate of $838 million was built on external channel checks and peer comparisons, not management color. When the actual number landed at $788 million, it exposed the uncertainty embedded in those models rather than a sudden deterioration in the business itself.
The bull case starts with the model itself. Ubiquiti's decision to operate without a direct sales force means its cost structure is structurally lower than every major networking competitor. Cisco, Aruba, and Extreme Networks all run large field sales organizations. That overhead does not exist at Ubiquiti. The savings flow directly to product pricing and margin, a genuine and durable competitive advantage.
Add in the hardware refresh tailwind. Enterprise networks need periodic upgrades, new Wi-Fi standards, higher bandwidth demands, security camera resolution improvements. Every upgrade cycle brings existing customers back to Ubiquiti without a sales rep having to close a deal. The full-year guidance of $3.4 billion, combined with improving gross margins, paints a picture of a business getting more efficient as it scales.
The bear case centers on valuation and transparency. At roughly $62 billion in market cap on approximately $3 billion in annual revenue, Ubiquiti trades at a significant revenue multiple. That premium is only defensible if growth is durable and margins stay exceptional. 1/4 of 6% revenue miss and 12% EPS miss is a data point. 2 or 3 of them in a row would be a structural concern.
The opacity risk is real too. When a company holds no earnings calls and releases minimal disclosure, investors are essentially trusting management completely. That works beautifully when the business is performing. But if something starts to go wrong, channel inventory builds, competition from Cisco intensifying, or a macro slowdown in enterprise IT spend, investors will be among the last to know.
There is also a concentration risk around Robert Pera. He holds approximately 90% of voting power. The company runs the way he wants it to run, full stop. That alignment has driven exceptional results historically, but it also means shareholders have almost no governance recourse if strategy needs to shift. Key person risk at this level is a legitimate bear argument for institutional investors bound by governance frameworks.
How does Ubiquiti stack up against the peer group? Cisco is the 800-pound gorilla, global scale, massive installed base, and deep enterprise relationships. But Cisco runs an enormous sales organization and reports multiple business segments with all the complexity that implies. Ubiquiti's lean model cannot match Cisco's breadth, but it wins on price performance for mid-market deployments where Cisco's margin structure makes it vulnerable.
Aruba Networks, now owned by HPE, targets a similar enterprise wireless market. Aruba competes on features and integrations, leveraging HPE's enterprise IT relationships. Extreme Networks is a smaller pure-play focused on cloud-managed networking. What separates Ubiquiti from all three is go-to-market cost. None of them have figured out how to deliver comparable products at Ubiquiti's price points while maintaining the margins Ubiquiti generates, largely because they all rely on direct sales.
Ubiquiti's growth rate of 18.7% year-over-year in fiscal Q3 is also competitive. Most legacy networking vendors are growing in low single digits, if at all. The mid-market enterprise wireless space is expanding, and Ubiquiti's reseller-only model scales efficiently into that fragmented customer base without requiring proportional headcount growth.
On the ownership and capital return side, the story is almost entirely Robert Pera. With roughly 90% of voting power concentrated in his hands, institutional activism is essentially impossible. Pera runs the company how he sees fit, and his track record justifies that autonomy. The business went from zero to a $62 billion market cap under his leadership without a traditional sales team.
The declared 80 cents per share cash dividend is a notable capital return signal. Ubiquiti does not do buybacks in a traditional cadence or provide detailed capital allocation guidance, but the dividend declaration is management saying the cash generation is strong enough to return capital even after a quarter that missed estimates. That is a quiet confidence signal buried in a minimal press release.
On the options market, implied volatility around Ubiquiti tends to spike into earnings precisely because of the disclosure vacuum. Traders who play earnings moves have learned that the miss or beat range is wide with no management guidance to anchor consensus. The 7% pre-market drop on this quarter is consistent with that elevated volatility pattern. For longer-term holders, these reaction moves have historically been buying opportunities rather than exits.
There are no notable recent insider purchases or sales to flag for this quarter. Again, the minimal disclosure culture extends to insider activity reporting timelines at Ubiquiti. Bottom line on Ubiquiti, the Q3 miss was real, $50 million in revenue and 54 cents in EPS. But 18.7% growth and strong full-year guidance suggests the business is not broken. The model remains one of the most efficient in enterprise hardware.
Whether $62 billion is the right valuation for this level of opacity is the central debate. If full-year guidance delivers, the dip looks like noise. If growth decelerates, the premium multiple compresses. Watch Q4 closely. Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street